Imagine walking into a room where a single piece of canvas, covered in what looks like accidental splatters of primary colors, is worth more than a fleet of private Gulfstream jets, 3 super yachts, and an entire block of prime Manhattan real estate combined. To the uninitiated, it is a triumph of human expression. To the global financial elite, it is something infinitely more practical, the ultimate bearer bond. It is a highly liquid, completely unregulated, anonymous asset that can sit in a temperature-controlled room for a decade without anyone knowing who owns it, where it came from, or how it was paid for. Welcome to the high-stakes world of international fine art, where the masterpieces of Western civilization have been quietly weaponized to build the most sophisticated, impenetrable money laundering network the world has ever seen. For decades, the public has been fed a specific narrative about the art market. We are told it is a playground for eccentric billionaires with a passion for aesthetics, a realm where culture is preserved and celebrated. But if you follow the money away from the bright lights of Christie's and Sotheby's, down into the subterranean high-security vaults of Geneva, Luxembourg, and Singapore, a terrifyingly logical reality emerges. The art market is not a sanctuary for culture. It is a highly efficient, multi-billion-dollar parallel financial system operating completely outside the jurisdiction of central banks, tax authorities, and international law enforcement. Consider this terrifying economic paradox. If you attempt to move $50 million in cash across an international border, you will be flagged by dozens of anti-money laundering protocols. Try to wire that same amount through a traditional bank, and you will be met with an onslaught of compliance checks, know your customer questionnaires, and requests for source of wealth documentation. But if you buy an oil painting by a dead European master for $50 million, you can roll it into a plastic tube, place it in a custom suitcase, fly it across the Atlantic on a private jet, and store it in a tax-free fortress without ever revealing your legal name to a single government official. The asset simply vanishes from the global financial radar, transformed from dirty paper currency into an untraceable, inflation-proof masterpiece. How did a market once reserved for connoisseurs and scholars become the premier choice for illicit capital flight? The answer lies in the unique structural anatomy of the art trade itself. Unlike the stock market or the real estate sector, both of which have been heavily regulated in the wake of post-9/11 counterterrorism financing laws, the global art market has spent the last half-century operating under an institutionalized code of absolute silence. In this world, anonymity is not a preference, it is the baseline currency. When a painting sells at a major auction house for $100 million, the official press release will almost always list the buyer as an anonymous private collector. This is not an ideological commitment to privacy, it is a structural loophole large enough to sail a superyacht through. The auction houses themselves often do not know the true identity of the buyer. Instead, they deal with Swiss lawyers, Caribbean wealth managers, and shell companies registered in the British Virgin Islands. The painting changes hands, the money moves through an intricate web of offshore accounts, and the legal ownership of a priceless cultural artifact is transferred to an entity that exists only as a line of code on a server in Tortola. To understand how the ultimate laundromat functions, one must first explore its geographical capital cities, the Freeports. These are not traditional warehouses, they are sovereign financial black holes. Nestled inside specialized customs zones in cities like Geneva, Luxembourg, and Delaware, these massive, bunker-like structures hold trillions of dollars in untaxed wealth. They are effectively modern-day versions of pirate international waters, constructed out of reinforced concrete and biometric security systems. When an artwork is shipped directly to a Freeport, it enters a state of legal and fiscal suspension. It has arrived geographically, but it has not arrived legally. Because it has not crossed the official customs border of the host country, no import duties or value-added taxes, VAT, are due. A masterpiece can be flown from New York to Geneva, driven directly into the Freeport's subterranean loading bay, and placed in a vault. From that moment on, it ceases to exist as a physical object subject to national laws. It becomes a pure financial instrument. Inside the quiet, climate-controlled corridors of these fortresses, a surreal form of commerce takes place. Paintings are bought and sold multiple times over without ever leaving their storage crates. A shell company registered in Panama can sell a painting to a shell company registered in Niue. The two owners might be sitting in the same room in Moscow or Dubai, but on paper, the transaction happens within the jurisdictionless vacuum of the Freeport. The money moves between offshore bank accounts, the warehouse registry updates the digital token representing ownership, and the painting remains entirely undisturbed in its dark, dust-free room. This structural setup solves the greatest problem faced by modern money launderers, the problem of storage and velocity. In the past, illicit wealth had to be hidden in cash, which rots, takes up immense physical space, and is incredibly difficult to deploy in the legitimate economy. Alternatively, it could be funneled into luxury real estate, but buildings are stationary, highly visible, and tied to land registries that governments can seize or audit. Art solves all of these vulnerabilities. It packs immense economic value into an incredibly small physical footprint. A single square foot of a canvas can hold more value than an entire warehouse full of $100 bills, and unlike real estate, it can be moved across the globe at a moment's notice. The true genius of the art market laundromat is the concept of subjective valuation. If you try to launder money using gold or oil, you are limited by global market commodities pricing. A bar of gold has a fixed value determined by its weight and the current market rate. You cannot suddenly declare a $1,000 gold bar to be worth $50 million without raising immediate alarms. But fine art possesses no intrinsic baseline value. Its price is entirely dependent on perception, scarcity, and narrative. If an art dealer, a prominent critic, and a compliant auction house agreed that a specific abstract painting by an emerging artist is worth $20 million, then for all legal and financial purposes, it is worth $20 million. This radical subjectivity allows for the arbitrary creation and destruction of wealth on demand. A bad actor looking to clean $10 million can buy an obscure artwork for a nominal fee, arrange for a series of artificial, manipulated private sales to inflate its provenance, and then sell it at a public auction to a controlled shell company for $10 million. The money that flows back to them from the auction house is now completely clean, fully documented, and backed by a legitimate transaction receipt from a world-renowned cultural institution. To the casual observer watching an art auction on a live stream, the process looks like a transparent, highly competitive display of free market capitalism. Bidders in the room raise their paddles, phone banks buzz with activity from international clients, and the auctioneer brings down the gavel with theatrical flair. But behind this public performance lies a shadow network of financial manipulation known as third-party guarantees and chandelier bidding. A third-party guarantee is essentially an insurance policy wrapped inside a speculative bet. Before an auction even begins, the auction house will often approach a wealthy investor or a syndicate and ask them to guarantee a minimum price for a specific star lot. If the painting fails to reach that price during the public auction, the guarantor is legally obligated to buy it at that predetermined price. However, if the bidding goes higher than the guarantee, the guarantor receives a significant percentage of the upside profit. This mechanism completely distorts the reality of public demand. It means that before the first paddle is raised, the painting has already been sold. The public auction is often nothing more than an elaborate piece of marketing theater designed to validate an artificial price point that was agreed upon behind closed doors weeks prior. For money launderers, this system is an absolute goldmine. It allows them to prearrange transactions, fix prices, and guarantee that specific sums of money will change hands, all while using the prestigious reputation of an auction house as a clearinghouse for their capital. Then there's the practice of chandelier bidding. This is a perfectly legal technique where an auctioneer is permitted to fabricate bids out of thin air to generate momentum and push the price up toward the seller's undisclosed reserve price. The auctioneer will look toward the back of the room or toward the ceiling, hence the term chandelier, and announce a bid that does not exist. To anyone in the room, it appears that there is fierce, competitive interest in the artwork. In reality, the auctioneer is bidding against himself on behalf of the seller. This systemic lack of transparency makes it virtually impossible for outside regulators to determine the true market value of any given piece of art. When the entire pricing mechanism of an industry is based on phantom bids, prearranged guarantees, and anonymous participants operating through shell companies, the line between legitimate commerce and organized financial crime completely dissolves. The market becomes a playground where billions of dollars can be moved across borders under the guise of intellectual appreciation. Consider the sheer scale of the global art market, which routinely generates over $60 billion in annual sales. Estimates by international law enforcement agencies suggest that a significant double-digit percentage of this volume is directly linked to illicit financial flows. Yet, unlike banks, casino operators, or even mortgage brokers, art dealers and auction houses have historically faced almost zero legal obligation to investigate the ultimate beneficial owner of the funds entering their accounts. They are under no mandate to report suspicious transactions to financial intelligence units. They simply accept the wire transfers, hand over the certificates of authenticity, and ask no questions. The true operational genius of the fine art laundromat reveals itself when you analyze how it exploits the global tax system. This is where the strategy shifts from merely hiding money to aggressively multiplying wealth through legal loopholes. The process relies on a dazzling financial maneuver known as the double-valued valuation trap, and it is used daily to drain hundreds of millions of dollars from public treasuries. The scheme works through a calculated exploitation of charity and appraisal laws. Let us break down the exact financial mechanics of how this works without using individual names, focusing purely on the institutional steps. Step 1. The acquisition. An entity acquires a collection of works by a relatively obscure or undervalued artist, often purchasing them en masse for a total investment of around $500,000. Step 2. The fabrication of provenance. The owner retains the services of compliant art historians, independent curators, and public relations firms to build an artificial narrative around the artist. They fund gallery exhibitions, sponsor academic monographs, and arrange for minor pieces from the same collection to be sold at secondary auctions where the bidding is artificially inflated by friendly shell companies. Step 3. The hyperappraisal. After a few years of this controlled market manipulation, the perceived value of the collection skyrockets on paper. The owner then hires an independent art appraiser, whose industry relies entirely on subjective comparisons, to evaluate the collection. Backed by the curated exhibitions and the artificial auction results, the appraiser signs off on a new valuation, $20 million. Step 4. The charitable donation. Instead of selling the art and paying capital gains tax, the owner donates the entire collection to a major public museum or a university gallery. Under Western tax codes, specifically in the United States, individuals and corporations can deduct the full, current appraised market value of a donated asset from their taxable income. The financial ledger of a manufactured donation: initial capital outlay, $500,000 cost of market manipulation, $200,000 final appraised asset value, $20 million tax write-off secured, $20 million net profit via tax avoidance, millions in cash savings. The beauty of this maneuver is that it is completely legal under current framework rules. The donor has effectively turned a $700,000 total loss into a $20 million tax deduction, wiping out their tax liability on entirely unrelated streams of income, such as corporate profits or real estate capital gains. The public museum is thrilled to receive a high-value donation that boosts its prestige. The appraiser takes home a hefty fee, and the public treasury is left holding the bag for millions of dollars in lost tax revenue. The dirty or highly speculative capital used to manipulate the market has been completely converted into clean, government-sanctioned tax savings. As the first part of our investigation draws to a close, we must confront the darkest dimension of this parallel financial architecture: its total immunity to global crises. When the stock market crashes, when real estate bubbles burst, and when governments freeze bank accounts during geopolitical conflicts, the fine art laundromat keeps spinning without missing a beat. In fact, crises often accelerate the system. When a government falls or a nation faces economic sanctions, traditional assets become liabilities. Bank accounts are locked, corporate shares are frozen, and factories cannot be moved. But a multi-million-dollar art collection hidden inside a Swiss Freeport remains completely untouchable. Because the ownership of these works is buried beneath endless layers of offshore shell companies and proxy trusts, international sanctions enforcement agencies find themselves staring at a brick wall. They know the art is inside the building, but they cannot legally prove who owns the company that owns the vault. This creates a terrifying reality where the world's most dangerous illicit actors can preserve their purchasing power indefinitely. They can use masterpieces by history's greatest creative minds as collateral to secure clean loans from boutique private banks, effectively converting their frozen wealth into highly liquid, usable cash. The art sits silently in the dark, serving as a monument to human genius on the outside, but functioning as a cold, calculating ledger for unchecked global capital on the inside. The ultimate tragedy of the high-end art market is that it has successfully commodified the soul of human culture into an untraceable financial derivative. It is a system designed by the elite, for the elite, operating completely above the law. But how exactly do these operations play out in real time? How do bad actors use art to fund illicit global operations? And what happens when the regulators try to fight back against an industry that refuses to be tamed? The answers lie deep within the shadow mechanics of the private gallery system, the exploitation of living artists, and the rise of digital art laundering, mysteries we will unravel in episode 2.